This video is called How the Real and Financial Economies Connect. The purpose of this video is to give you a simple way to graphically visualize how the various components in the real and financial economies link together. If you are sometimes overwhelmed by all the different news and data points, this will help put them into compartments so that your understanding of how the system functions will be a lot clearer. So this is what the framework looks like. On the left-hand side, we have the real economy, and on the right-hand side, we have the financial economy. And in the middle, we have a few variables which we call facilitators. We will now go through each of these components and briefly show what drives each of them and how they connect. The real economy here is highlighted in yellow. On the left-hand side, we have GDP components, which are investment, net exports, government spending, and consumer spending. Those four items make up GDP. And on the right-hand side, we have corporations which operate in the real economy and which extract earnings out of the flow of money moving around as part of GDP dollars. So they are collecting part of that GDP revenue, but are paying out money in wages, cost of goods, taxes, and interest, and whatever is left equals corporate earnings. On the financial economy, you have three different sectors. You have the bond market, the equity market, and the currency market. In the bond market, you have government bonds at various maturities, short and long term, and then you have corporate bonds at various levels of risk. The currency market is a big market with many currencies traded, but we are really only interested in the trade-weighted value of the dollar. The equity market consists of all publicly traded equities on various exchanges like the NYSE and NASDAQ. Corporate earnings and the earnings multiple combined determine the total value of the equity market in the bottom right-hand square. So that's how that works so far. The facilitators take on various states that can have an impact on both the real and financial economy. So you have the government, which is involved on both sides in the form of both monetary and fiscal policy, and you have inflation, which is generally a function of GDP growth and capacity and/or labor utilization. And lastly, the level of debt outstanding in all sectors can have an impact on both the real and the financial side. So here's coming back to the real economy. Let's look at the things that impact GDP. You can see the arrows showing which items impact others. Let's start, for example, with consumer spending, which is impacted by wages, household debt, interest rates, and equity values. Government spending is impacted by government finances or debt levels and by government fiscal policy. You have investment, which is really driven by growth in consumer and government spending, and imports and exports are influenced by the dollar. This is corporate earnings. Cost of goods sold will be a function of inflation, implying growth and capacity, and the dollar. Wages are a function of GDP and employment capacity constraints. Interest expense is a function of interest rates and corporate debt outstanding, and taxes are a function of government fiscal policy. So that's how corporate earnings are impacted. Coming back to the financial economy, let's look at interest rates. So the federal funds rate is determined by monetary policy, and that in turn has an impact on the long-term rate, the GS10, which is a function of the federal funds rate plus GDP growth plus inflation. And then that goes on to impact corporate bond interest rates, which are also impacted by the amount of corporate debt outstanding and the level of corporate earnings. Here is the equity market. So earnings come from the real economy out of the corporation column. And then the earnings multiple or PE ratio is a function of interest rates plus an equity risk premium. And the equity risk premium is generally determined by GDP growth expectations. And then here we have inflation, which is its own separate box and is a function of GDP growth and capacity and/or unemployment. And lastly, we have the dollar, which is also impacted by GDP growth and inflation. And so that is how it all fits together. If, for example, you wish to know how equity prices are determined, start with the equity section on the financial economy side and work backwards to see what the drivers are. So that's it for this video. Hopefully being able to visualize which compartment things fit into will give you a clearer understanding of how the real and financial economy interact and the primary drivers of each. Thank you.